I'm going to do two presentations today. The first one is CECL, and then I'm going to do a presentation on BSA with considerations for hemp and marijuana related businesses. So let me just start off with the current expected credit losses. And as many of you know, this has been a significant undertaking by the Financial Accounting Standards Board, significant reporting changes for banks. Banks have been using the incurred loss model for many years. I mean, I've been a bank examiner for 29 years, and the incurred loss method has been around longer than I've been around banks. So, but now a very significant sea change, a reporting change, and we're going to talk about it at a high level today. But the very first point I want to start with is that there are no plans to defer or cancel CECL. I mean, discussions about CECL have been around for many years. And there was a bank meeting earlier this year, one of our state charter banks, that because of their asset size, they thought that that CECL wasn't going to apply to them. So as a matter of months ago, they had not even started any implementation of CECL. But everything I'm hearing, it says that there's no plans to defer CECL. It's been deferred for 2 or 3 years. I attended an accounting specialist conference back in March, and at that conference in March, they said the same thing. They said, the implementation date is January 1st. There's no plans to defer. So I just wanted to say that the last bullet point on this slide, if you haven't started anything related to CECL yet, implementation, or you haven't fully adopted, don't panic yet, but you're very close to hitting the panic button. So, but we're going to go over all seriousness. We're going to go across some things today about where you should be. And if you haven't started implementing CECL at all, or if you have, but you're not fully adopted, there's still time. You've still got about 6 months. So I'll just go over some time frames and things you should be doing. But on that slide too, and this is sort of older information, but at that March conference I attended, they talked about that only about 330 banks in the United States had even adopted CECL yet. And so there were still over 4,000 banks that hadn't adopted CECL. But that makes sense when you think about it too, because most of the banks in the United States, not by dollar, but just number of banks in the United States, most of them are community banks that are smaller, that are under $1 billion in assets. So they wouldn't have had to have been required to adopt CECL. And we have 38 state chartered banks in the state of West Virginia. And I realize there's also people here from other states, but of our 38 state chartered banks that we currently have, I think only 3 of them were even had to adopt CECL previously. So the other 35 still have till January 1st. Just a little background on CECL. So FASB came out on June 16th, 2016, and issued its formal guidance regarding the new CECL methodology for calculating the loan loss reserve. And then the very next day, on June 17th, 2016, the federal regulatory agencies came out with a joint statement and issued on CECL. So, and this is something we'll talk about a little bit later in the presentation, but if your institution hasn't done anything, if you haven't started with CECL, this would be your starting point to review the FASB guidance and their interagency guidance, just to sort of see what's expected and where we're at. Okay, the next slide. Okay, and then these are just some old terms. If you've been around a long time, like myself or Alan, you probably recognize these numbers. I still use the old FAS 5 and FAS 114 numbers, so I haven't even graduated to the ASC numbers, and now I've got to graduate to the CECL number. But so the new CECL guidance replaces ASC 450 and ASC 310, and so those numbers are no longer the accurate numbers. Okay. Next slide. Okay, so now our first attendance poll question. Which team won the NBA Finals this year? And I can tell you the team that won was not my favorite team. It was not the team I was rooting for. So, and if you know much about NBA, you'll know that I'll just give you a little hint. The Georgia Bulldogs is not an NBA team. So. Okay, this slide just goes over the scope of CECL. So what actually is included in CECL and what's not included in CECL. So basically anything that's held to maturity that you're not selling is included in CECL. So loans, most of the loans that are community banks that are held for investment that you're not selling are included. HTM debt securities are included. And then off-balance sheet credit exposures. And just a quick point on that. So any of your off-balance sheet lending, unfunded lines of credit, et cetera, those are included in CECL, but they are recorded as a separate liability. They'll be recorded in other liabilities. So there'll be a separate recording from the actual allowance for credit losses, but they are included, but just in a separate place. And then basically anything available for sale is excluded from CECL. So held for sale loans and available for sale securities are not included within the scope of CECL. Okay, and just some more information about CECL. What is CECL and what's sort of included, and what's some of the differences between the old incurred loss method that's been around for years and years. So the CECL model is more of a forward-looking approach. The incurred loss model was looking at past events, looking at historical losses, but the CECL model is more forward-looking, and we're going to get into some more of the differences as we go along. But the CECL is a very forward-looking approach. And it requires banks, when they implement and fully adopt CECL, that on day one, that they would have to make a determination of the amount to be collected from the loan over the life of the loan. So under the old incurred loss method, one of the big differences, you made a loan and maybe it was a 10-year loan. Well, until there was some kind of loss, you weren't booking any kind of loss, and you were just using your historical charge-offs plus qualitative factors to sort of develop some type of loan loss reserve. But with CECL, you make a 10 or 15-year loan today, and on day one, you've got to sort of determine or estimate what is your loss for that loan and then allocate it up front. So the difference between the original loan balance and the amount expected to be collected is your CECL allowance. And we'll go into some more detail about this through the course of the presentation. Next slide, please. Okay, so what's the CECL starting point? And hopefully, I know there's a lot of people, a lot of banks represented from multiple states at the webinar today. So hopefully most banks represented in the room have already, CECL has been, you're far along in the implementation stage. Maybe you haven't fully adopted CECL, but you're well on your way. But if you're not, don't panic. We're going to walk through some things you need to do. So you still have about 6 months till January 1st. So a CECL, just like in the incurred loss method, historical loan losses is your starting point. So you can still use historical loan losses under CECL just like you did under the incurred loss method, at least as your starting point for the allowance. You can also segment your loan portfolio into pools of similar risk characteristics and calculate your losses for the CECL pool. And then qualitative factors are still in CECL. They don't go away. So you start with historical loan losses. You adjust these for qualitative factors. But the big difference is this next bullet point, you use relevant forward-looking information and expectations from reasonable forecasts. So we're going to talk about the forecast more as we go along, but that's one of your big differences with CECL. So you're still using historical loan losses where you can. You're still using qualitative factors, but then we're also looking at a lot of forward-looking information based on forecast and other things we have. Okay, and so really, to me, over the last 2 years, because our publicly traded SEC filers, which is most of our larger banks, had to start adopting CECL a couple years ago, and so the biggest thing that I've seen, at least in our larger banks in West Virginia, where they've looked at these reasonable and supportable forecasts, comes from a lot of unemployment rate forecast, and we're not I'm not supporting one over another, but I'm just saying as an example, our largest bank in West Virginia was using the Moody's forecast to use for their forecast for reasonable expectations in the future. And so really what happened with that, and part of it was just the timing. CECL starts right around the time of COVID. So in 2020, businesses are shut down or locked down. Unemployment's going through the roof. There's a lot of bad economic indicators. And so I know a lot of our larger banks were putting huge amounts of provision expense into their allowances, based on these forecasts, these unemployment forecasts. Well, then 2021, a year later, things start to get better. Businesses are employing people. People are going back to work. The forecast for unemployment looks much better. And so now all of a sudden, the same bank that in 2020 is putting significant amounts of money in provisions, and their earnings are cut in half. In 2021, they're doing reverse provisions, negative provisions, or no provisions. And so the unemployment rate forecast, at least in my opinion, in the early years of CECL, in these first couple of years for our SEC filers, has been a huge factor in calculating the overall allowance amount. On commercial loans, you can still do some type of individual loan analysis similar to the old FAS 114 impairment analysis. And these next few bullet points are very important. Although the FASB came out in 2016 and said basically that we're going away from the incurred loss method for calculating loan losses, and now we're going to the CECL method, which is a forward-looking method where you have to calculate your loss on day one when the loan is made. But the FASB did not regulate or set any specific method that you have to use. So depending on the size and complexity of your bank, you may not need a complex model at all. There's a couple of methods, the WARM method and the scale method, that are out there. And again, these aren't, the FASB is not saying you have to use them. The Federal Reserve has came out with one of these methods. And just some information I read even today made it sound like that probably somewhere close to 75% of all banks in the United States may end up using either the WARM method or the scale method. And those percentages could have changed. The information I was looking at, it wasn't today, wasn't super current. But one reason that a lot of banks would use that, I know the scale method, for example, that's for banks that have under less than 1 billion in total assets, and it's more of an Excel spread or spreadsheet based method. So like I said earlier, a lot of banks in the United States are under 1 billion in assets. But the FASB doesn't regulate that it has to be any method. But these are two methods that look like they are going to be very popular as far as CECL on a going forward basis. Okay, so in a previous slide, I talked about the historical loan losses is your starting point, and you can segment your loan portfolio into pools. So if you're segmenting your portfolio by pools, they need to be pools of similar risk characteristics. So these are just some examples of different characteristics that you might group your loan pools by. This is not an exhaustive list, but it could be the size of the loan, the collateral type, maybe it's a commercial real estate loan, the internal credit score, risk ratings. So these are just examples of different characteristics that you can group and segment your pools in your loan portfolio to use for part of your CECL calculation. Okay, our next attendance poll question. So which regulatory agency supervises federally chartered credit unions? And I don't know if there's any credit unions represented at the webinar. And one key here is that I said federally chartered because the state of West Virginia regulates state chartered credit unions, but this is specifically for federally chartered credit unions. So is it the NCUA, the NCAA, the FDIC, or the Consumer Finance Bureau Protection Bureau? Okay, a transition period and day one CECL adjustment. Okay, so with the CECL, with the transition from the incurred loss methodology to the CECL methodology, on day one when banks adopt, which primarily most banks in the United States will be adopting January 1st, 2023. So on that day, basically on January 1st, then the banks will have to calculate. So what is the cumulative effect between what the allowance would have been under the incurred loss method compared to what it will be under the CECL method? And then that adjustment will have to be made on day one of the reporting period. And so the way that will work is whatever that dollar amount of cumulative effect adjustment would be, it won't flow through the income statement, but it will flow through retained earnings. So retained earnings would be reduced for the dollar amount, and then the allowance for the credit losses would be increased. And under the guidance, because this dollar amount could be material for a lot of banks and could be a big impact on capital, then there has been an election where banks are allowed to spread the capital impact over a number of years. So if the dollar amount of capital impact is going to be very significant or material for your financial institution, you can elect to, instead of doing that all in the very first year, instead of 2023, you can elect to spread that out over multiple years. And I think a lot of our banks are doing that. And the larger SEC banks that you had to adopt, effective January 1st, 2020, they were allowed to defer that, I think, and spread that over a 5-year period. But that is an election that banks can do. So with their day one CECL adjustment. So probably for everybody in the room, that's going to be January. Okay, so planning for the CECL model. So let's say worst case scenario, there's a bank in the room where you guys have done nothing with CECL, or you thought because of your asset size, CECL wasn't going to apply to you, or you thought maybe the FASB was going to defer the CECL date one more time. And so worst case scenario, you've done nothing. You still have 6 months. So here's sort of the plan. Here's what you should start almost immediately with planning for CECL. So determine the applicable effective date. Well, we've already discussed that it's January 1st. 2023 for everybody else in the United States. And then the slide where I had the FASB guidance from 2016, and then the very next day, the interagency guidance on CECL. So become familiar with that standard. So if your bank has done nothing, what I would do is probably in the next 15 days, have a board meeting, and the president or CFO or somebody from the bank or chief credit officer go over the FASB guidance and the interagency guidance with the board. And then the next step would be to identify what areas and what departments within the bank are going to be impacted by going to this new CECL method. And of course, obviously, credit, your loan department is going to be very impacted because they're going to have a lot of loan information and historical loss information and maybe know things about borrowers specifically. But your accounting department is going to be very involved, and also your IT department. So you need to identify and get all departments in the bank together that are going to have some involvement in preparation for transition to the CECL model, and which goes right into the next step, form a CECL committee. So you probably need to form a CECL committee within the next 30 days if you haven't already. That would have, the president of the bank and then people representing these various departments, accounting, credit, IT, et cetera, so that you can get together on a regular basis to start discovering or discussing what we need to do with implementation and adoption for CECL. And then there needs to, once the CECL committee is formed, then you can develop some type of specific CECL implementation plan with a timeline, a time frame. We need to have the CECL committee. We need to be involving these areas of the bank, and we need to contact outside auditors or regulators, et cetera. And we'll discuss that more involved. But worst case scenario, if you haven't started at all, everything we just discussed about, I would try to make sure you had done within the next 45 days. and then continuing the planning for the transition to CECL, communication with your outside vendors and or with your external accountants and regulators. Now, from the previous slide, I discussed just briefly the WARM model and the scale model. And again, from what I read earlier, to me, it looks like that the majority of our financial institutions are probably going to go with one of those models, but that's not mandated. You don't have to. So you could check with your outside vendors and see what they have, or what their what kind of models they have, or they can discuss with you, and also your external accounts and regulators. What are they seeing, and what's out there? And I would say, just as a timeline, probably within the next, if you've done nothing with CECL or you're still implementing it but haven't fully adopted, I would say within the next 60 days or 90, worst case scenario, you need to probably decide what plane you're going with. We're using an outside vendor, we're using a WARM model, we're using the scale model. And that's all very important because of that last bullet point on that slide. The last bullet point was talking about running parallel model runs. And that's extremely important because you need to make sure that whatever model you select to go with CECL, whether it's WARM, scale, another outside vendor model, whatever, is going to work and going to meet the guidelines to be CECL compliant. So that's a very important decision.
Hey, Nathan. Yeah, we appreciate the insights on CECL. One question came in. There may be others, and again, for the participants, feel free to either email us or you can chat any questions or comments that you may have. One question came in kind of from a obviously examiner perspective, boots on the ground. Are there any specific issues or concerns that you or your staff are seeing in the pre-implementation phase? Again, just kind of any practical issues or concerns that you may have.
That's a very good question. And I would say at this point that so far, I don't think so. Nothing that I'm aware of. We actually have a CECL questionnaire that our examiners are required to complete on every examination. And we've been utilizing that probably for the last 3 or 4 years. And it just sort of goes through a discussion with the bank, to see whether they've formed a CECL committee, whether they're talking to outside regulators, their vendors, where are they at timeline wise? Have they made a decision? So, and again, we've been doing this for a good while now. So most of our banks, well, I guess 2 points I would make. Of course, again, most of our banks have not even fully adopted CECL yet because it wasn't required, but most of them are in the process. But based on the communication that we're having with our banks through that questionnaire and through the examination process, I really so far haven't really seen any what I would call significant or material issues in CECL implementation. Most of the banks that I've talked to seem to be right on track. So.
Mm-hmm. Yeah, I would say that's been our experience too.
Yeah. The only exception I would say, there was that one bank earlier this year that they were actually going through an examination with the FDIC, and they had not even started because they thought they were going to be exempt. So.
Yeah, I'm sure that's clearly the wrong answer, isn't it? So, yeah. I guess it's just a parting shot. Probably most of the folks on the webinar here know that last week the Federal Reserve put out another CECL tool. I guess the acronym is ELE or LE, which is basically an iteration of the WARM method. And again, that just came out. So I know a lot of folks are scrambling to kind of look and see what that's about, maybe compared to scale for the folks that were looking at using scale. So Nathan, unfortunately, I'm sure you guys will get lots of questions on that. So we might say better late than never. But again, that gives the bankers, especially maybe the smaller institutions, just another option. So thanks again. I'll get out of the way and let you move on to the BSA presentation. Thank you.
Thanks, Alan. Hey, Dana, and just a quick program note, and maybe I'm not supposed to, but I'm not seeing any of the polling question responses, and I'm not seeing any of the questions, but that's fine. I don't have to, but I haven't seen any of those yet. But okay, well, the next presentation I'm going to do is BSA considerations related to hemp and marijuana-related businesses, and I do a lot of BSA exams for the state of West Virginia. That's one of my specialty areas. I've done that for many years. And this is something in the last several years, we're really getting lots of questions from our banks and a lot of activity, a lot of things going on. And I know in this webinar, we've got people not just from West Virginia, but from Virginia and other states. But I'm just going to sort of give a brief history of West Virginia, of where we are in West Virginia, and sort of how we got started in West Virginia related to hemp and marijuana. So in 2017, the West Virginia State Legislature passed the West Virginia Medical Cannabis Act. And it didn't become effective until 2 years later, in July of 2019. And the important point to note on that is that in West Virginia, only medical marijuana is legalized, so not recreational marijuana. So it's been going now for about 3 years in the state of West Virginia. And then the West Virginia Medical Cannabis Act was formed to help out with the application process. There's a lot of dispensaries. Just even in the area where I live, within a half an hour drive, I see various CBD businesses. So it's really taken off, and there's a lot of activity going on within our space within West Virginia, and just sort of an evolving process with a lot of questions. And West Virginia, and we'll talk about this more through the presentation, but the West Virginia Division of Financial Institutions, we've taken the aspect or the step that we're not a law enforcement agency. So if we go into any of our financial institutions and they're banking marijuana related business customers, we're not going to criticize the bank solely just for the fact that they're banking a marijuana customer. And we'll talk much more in detail during the presentation about this. But what we will criticize is if banks have banked marijuana related businesses and they're not doing their proper due diligence, including their BSA policy, their risk assessment, CDD, CIP. So we're not a law enforcement agency, but we are looking very hard at that if we do have any banks that have that type of activity. And then this next slide is just some more information about specifically relating to the state of West Virginia. Not really pertinent that we need to know, but if one of these growers or dispensaries is trying to get a license with the state of West Virginia, there's a $5,000 application fee. There's a license fee of $50,000. So this is a very regulated, licensed industry, and it does require registration and licensure with the state of West Virginia and with the West Virginia Department of Agriculture. And really, the 2018 Farm Bill, this is really the important piece of legislation that really has really where a lot of questions didn't come from, and really where a lot of the disconnect came from. So the 2018 Farm Bill, which is called the Agriculture Improvement Act of 2018, removed hemp as a Schedule I controlled substance under the Controlled Substance Act. So now in the state of West Virginia, for example, and I'm sure probably lots of states, we have a lot of stores, whether it's mom and pop stores, in Walmart, other stores where they're having CBD oils, CBD products, a lot of things from hemp. But the important point to note is that this 2018 Farm Bill only made hemp legal. Marijuana is still illegal at the federal level. And so that's where a lot of the questions come from and where a lot of the disconnect is. So if a bank is doing any business with a marijuana related customer, any activity that marijuana customer is still illegal under federal law. And we'll discuss a lot more about that during the presentation. Okay, our last polling question. So what is the capital of the state of West Virginia? And just to give you a little history on this, and this may give away the answer too, but West Virginia hasn't always had the same capital. Wheeling for years was the capital of West Virginia. Shinnston is the town that I live in. So I've probably just eliminated a couple answers for you. Okay, so hemp requirements under the USDA final rule. And really, I'm only going to concentrate primarily on the second bullet point. So the technical term is tetrahydrocannabinol, which is called THC because it's hard to pronounce probably. But the big point on this slide is that THC levels of 0.3%, so that's less than a percent, less than a third of a percent, that's the benchmark. And my understanding is, and I'm not a marijuana expert, but my understanding is that hemp and marijuana, I believe, both come from the same plant. But if it has 0.3% or less of THC, it's considered hemp and is legal. And if it has more than that, it's considered marijuana. And just on a side note, on a couple of BSA exams this year, it's came up where in the bank's BSA policy, instead of listing a THC level of 0.3, they were listing 1.0. So I don't know whether there was some misinformation or misinterpretation on that, or whether years ago the state of West Virginia did have 1%, but 0.3% is the benchmark. That is the big number that we look at. And really, the hard part too has been testing. My understanding, and again, I'm not a marijuana expert, but my understanding is even when they're going through the process of making some of these products, that during the actual cooking or whatever the process is called, that your THC levels can actually increase and go above 0.3%. And just a matter of months ago, I read, I believe it was in Charleston, West Virginia, that there was a CBD, either a store or a producer, that they thought their product was 0.3% THC. But when testing was done, it actually ended up being more than that, which would have made it marijuana, which would have made it illegal. And I wanted to bring that point up just because you might be thinking, well, hemp is now, legal. It's no longer a Controlled Substance Act, or under the 2018 Farm Bill. And you would be right in that. And so you would think, well, what's the risk with that? Well, a couple of risks would be, one, what kind of testing guidelines is being done. So if you've got a customer that's selling hemp or making hemp, growing hemp, but is there rigorous testing guidelines? Do they know for sure that it's, below this 0.3%? So, although hemp doesn't have the same risk as a, banking and marijuana customer, there are still risks to look at, and also licensing for hemp producers. If you're selling hemp, making hemp, whatever, you still need to register with the West Virginia Department of Agriculture. Okay, so because hemp is no longer a Schedule I controlled substance, banks are not required to follow SAR. But that bottom point, you're still expected to follow standard SAR procedures. So this is one of the main differences with SARs and BSA between hemp and marijuana. So if you're banking a hemp customer, which that's fine, and as long as you're doing your due diligence, there would be nothing out of the ordinary. You would just treat that customer the same way you would any other non-marijuana customer for BSA purposes. So you wouldn't have to do any special SAR reporting like we'll discuss with marijuana activity later in the presentation, but you still would be required to file just a normal traditional SAR on the hemp business if they were doing something that was unusual or suspicious. So SARs would still have to be filed, but just not the kind we're going to talk about later regarding marijuana businesses. Okay, so BSA considerations for hemp businesses. And let me just say before we go through these, so several of these BSA considerations are going to be the same, whether you're just a normal business customer that's not a hemp business or not a marijuana related business. And then all of these are also going to apply to any marijuana related business customers that you would be banking. The difference is there'll just be probably one or two on this list that I'll discuss that are just hemp, and then some that on the list later that are just marijuana. And I did want to make one other distinction also. So far, out of our 38 state chartered banks in West Virginia, until about 3 months ago, I wasn't aware of any of our banks that had banked any marijuana related customers. We've gotten several questions about it over the years, but wasn't aware of any banks that did that. Then I think in April on one of our banks, The bank had actually banked a marijuana related customer accidentally and didn't know it. So they did find out about it. And so, like I said earlier, we're not a law enforcement agency, but if you do bank a marijuana related customer, then we're going to look at what was your account opening process, what was your policy, your risk assessment. And in this particular case, I don't really criticize the bank for not knowing that they had banked a customer, because depending how much information the customer gives you at account opening and onboarding and whether they're honest with you, it might be easy to accidentally bank a marijuana related customer. But then from that point forward, the bank didn't do a very good job of monitoring and activity after that point. So we'll talk about some of those things. But just for hemp businesses and any customer, you need a BSA compliance program. You should be looking at your CIP information, doing SAR and CTR reporting, and getting beneficial information. And then if it's a hemp customer, you need to also verify and review with the state that they have the proper licensing and registration requirements have been met for this business. Okay, now let's talk about marijuana related businesses. So again, marijuana is still considered illegal at the federal level. It's still considered, under the Controlled Substances Act, it's illegal to manufacture or distribute or dispense marijuana. And you may have heard of the Cole memo. This has been around for several years, but James M. Cole, through the U.S. Department of Justice several years ago, had came out with a memo that listed what's called the Cole priorities, things that are very important, and it was specifically related to the enforcement of marijuana. And so on the next slide, I listed some of the Cole priorities. It's not an exhaustive list. I think I just listed 4 or 5 of these Cole priorities. And so the first one is just preventing the distribution of marijuana to minors. And all of these Cole memo priorities are trying to prevent some type of bad activity, bad actors. The second one, to prevent revenue from the sale of marijuana going to drug cartels, criminal enterprises, etc. The bottom one, preventing violence and the use of firearms with the distribution of marijuana. And where these Cole memo priorities are really important and come into play specifically for financial institutions, as we'll start talking about on the next slide, is the various SAR reporting, the SARs that you have to report. And there's brand new or a different set of SARs that you have to report on a marijuana related business than on any other type of business. And a very important point to note is this first bullet point. The obligation to file a SAR is unaffected by any state law that legalizes marijuana related activity. So in West Virginia, again, since 2019, medical marijuana has been legal in the state of West Virginia. And many states have medical marijuana and or recreational marijuana that's illegal, but it's still illegal at the federal level. So any business customer that you would bank that's doing marijuana related activity, that's still an illegal activity at the federal level. Therefore, you would still be required to file a SAR on activity that they're doing. And we're going to get into there's 3 new SARs that banks have to file on marijuana related businesses that you don't have to file on the other ones. And I think that's on the next slide. Yes, so here's the first one, the marijuana limited SAR filings. So if your financial institution has banked a marijuana related business customer, then you're automatically going to have to file, at least at a minimum, the marijuana limited SAR filing. And the key distinction is with the Cole memo priorities. So on the marijuana limited SARs, if you've banked a business customer that has some type of marijuana activity, regardless of what level of activity it is, if you don't feel like that customer's business is implicated in one of the Cole memo priorities, so in other words, it's not distributing marijuana to minors, it's not getting a revenue to drug cartels, any of those priorities that I had listed on that screen, then in that case, you would still have to file the SAR, but it would only be a marijuana limited SAR. And on that SAR, it's very limited information that you have to fill out when you're disclosing, when you're filling out and then filing that SAR. And then that bottom bullet point is important too, just on your regular customers. For years, if you had a customer that you filed a SAR on, but they continued to have that suspicious activity, then every 90 days, there was a continuing SAR activity. Well, the same thing with the marijuana businesses, because of the fact that marijuana is illegal at the federal level, and any activity they would be doing would be considered illegal. Then not only do you file the initial marijuana limited SAR or the other kind of SAR that we'll talk on the next screen, but then as long as this activity continues, you'll be filing continuing SARs. And so the marijuana priority SARs. So this would be, so you've still got a marijuana related business as your customer, but in this case, you feel like that the customer does violate one or more of the Cole memo priorities. Then in that case, you have to file what's called a marijuana priority SAR, and the content that you put in the narrative section of this SAR is going to be a lot more comprehensive, a lot more detailed. You're going to be required to disclose a lot more information. So again, the marijuana limited, you feel like they don't violate the Cole memo priorities. Marijuana priority SARs, they do. And then on the next slide is the very last marijuana SAR that you possibly might have to file for a marijuana related business. This would be the marijuana termination SAR. So in this case, your financial institution has banked a customer that's doing something marijuana related, and for whatever reasons you feel like that it's necessary to terminate the relationship with this customer in order to maintain an effective AML program. Then in that case, you file a SAR and note in the narrative this is a marijuana termination SAR. And I don't know about other states, but again, in the state of West Virginia, I haven't seen any of these SARs, because until about 3 months ago, I wasn't aware of any banks that even had any. Okay, looks like we've got a question. We've heard from various sources that banks should have a cannabis banking policy to address whether they will bank marijuana, hemp, and/or CBD. While this may not be required by any particular regulation, is this something that you're seeing banks put in place, and would you recommend it? A very good question, and my answer would be yes, yes, and yes. So yes, on every BSA exam that I do, that's one of the things that I look for. Do you have a BSA policy that covers these type of activities? Most banks that I've looked at do. Most of the banks in West Virginia that I've reviewed BSA, their policy specifically says we will not bank BSA customers. And a lot of the policies are pretty specific. If they do have, like I say, a couple of the policies that I looked at this year even had the THC levels. They had some information about, proper due diligence, what they should do for those type of activities. So the short answer is yes. Every bank should in their BSA, and it can be part of the BSA policy, or it can be a separate CBD policy. I've just seen it as a addendum or a separate section to the BSA policy. But yes, you should be covering these activities in your policy, and that is something I look for. And if I don't see it, then yes, I would recommend it. So. And just to go into a little more detail, also the bank that I referenced earlier this year that accidentally banked a medical marijuana business. Well, so some of the recommendations we had. So once they found that they had that policy, initially, probably within the next couple of weeks, they should have went to the board and said, well, we've got a marijuana related business. We didn't know about it. And then the board should have discussed it. And there should have been a decision made at that point on whether we're going to keep this account or close it. Well, we couldn't really tell from the board minutes. There was really not much discussion documented. We couldn't really tell what they did, except for the account's still here. So we know they're keeping the account. But, the risk assessment was either silent or didn't have much on it. So, I think we had recommendations for their policy, for the risk assessment. There were several recommendations. So, but yeah, that's something that should be covered in your policy. And then the last slide, the last thing that I want to cover related to the marijuana related businesses, we also get questions from bankers. Well, what if it's an indirect service? And just to give you an example of one of our banks had given us a question. So this particular bank had a member of the board. So he's one of the directors. So he's a director of the bank, a customer of the bank, has the loan at the bank, and his loan was for a commercial building. So he's making loan payments to the bank. Well, this commercial loan, commercial property, commercial building that the director owned, he was actually leasing his commercial building to I can't remember if it was a dispensary, but somebody that had a medical related business, either a dispensary or they provided, marijuana to customers. And so he was receiving lease income from this medical marijuana business. So then in turn, the lease income he was receiving was being deposited into the bank. So again, he's a director of the bank, a customer of the bank, has a loan with the bank, and he's leasing his building to a medical company who's paying him income, and then that income is being deposited to the bank. So then the question is, well, what do we have to do from that standpoint? Do you file SARS? Well, this was considered an indirect service. So it's the director is a customer of the bank, but the medical related business is not. So basically it's a customer of the bank's customer. So in that case, it's considered an indirect service. So the bank doesn't have to do any of the marijuana related SAR filings, doesn't have to do the medical marijuana or the marijuana limited priority SAR or the priority SAR. All they would do, they would just monitor activity of the director. And then if there was anything suspicious, just file normal SARs, but they wouldn't have to do anything separate because it's an indirect business that's not directly related to the bank. So that concludes my presentation. If you have any other questions, I'll be glad to take. Oh, I'm sorry. I guess it doesn't conclude my presentation. So a lot of these BSA considerations for marijuana related business are going to be the same as for hemp or just for any non-hemp or non-marijuana. But near the end, the BSA policy, again, is important. We would want to see a separate section just on marijuana related business and some proper due diligence procedures that the bank would do if you banked one of these customers. The next one, the BSA risk assessment, we would want to see some specific quantitative information. For example, how many accounts do you have? Does the bank have 5 accounts that are with medical marijuana related businesses, or you just have one? And that information and the BSA risk assessment is important because the whole purpose of the BSA risk assessment is to help guide the BSA department in what resources and time do we need. So if you've got 7 7 marijuana related businesses, you're going to need probably some decent amount of resources from your BSA department. Okay, another question. Do you see banks doing searches of their customer bank to make sure they are not banking a marijuana related business? Well, that's a good question. I don't know specifically whether any of our banks are. I think definitely, and the point on this slide was more related to once a bank has already banked a marijuana related customer, then they should be going out to public databases, social media, whatever, and looking to see if they can find any information that would either be information related to violation of co-memo priorities. You might find out some information that would make you decide you want to terminate the relationship. But yeah, I think banks should be looking at publicly available sources for those type of customers. And this is sort of a side note, but looking at publicly available sources of information is very important for a lot of things. I mean, I use it myself. I do most of the hiring and interviewing for the Division of Banking. A lot of times if there's a potential candidate I'm even considering making a job offer to, I'll go out on social media just to make sure there's nothing bizarre or weird, or the person's talking about blowing up federal building. So I use social media myself, for hiring decisions. I mean, just as one aspect of it. But so the bottom line, if I could just sort of sum up, there's more risk with marijuana related businesses, but there's also risk in banking hemp, for the testing, the 0.3 THC levels, and also for licensing and registration requirements with the state. You would file just normal SARS for the hemp businesses if one came up, but marijuana related businesses, you would definitely be filing SARS.